The impact of inflation on long-term investments. Inflation is a critical factor that affects the value of money and purchasing power over time. For long-term investors, understanding how inflation impacts investments is essential for maintaining and growing wealth. Inflation can erode the real value of investment returns, influence market dynamics, and alter the effectiveness of different asset classes. This article explores the impact of inflation on long-term investments and strategies investors can use to mitigate its effects. What is inflation? Inflation is the rate at which the general level of prices for goods and services rises over time. As inflation increases, the purchasing power of money decreases, meaning that a fixed amount of money will buy fewer goods and services in the future than it does today. Central banks, such as the Federal Reserve in the United States or the Bank of England, often target a specific inflation rate, usually around 2% per year, as a sign of a healthy economy. The impact of inflation on different asset classes. Inflation affects various asset classes differently. Some investments may benefit from inflation, while others may suffer. Here's how inflation impacts some common types of long-term investments. Cash and cash equivalents impact. Negative explanation. Cash and cash equivalents, such as savings accounts, money market funds, and short-term government bonds, typically offer low returns. During periods of inflation, the real return on these assets becomes negative if the interest earned does not keep pace with inflation. For example, if inflation is 3% and your savings account earns 1% interest, your real return is 2%. Meaning your purchasing power is decreasing. Bonds impact. Negative, for most bonds, mixed, for inflation-protected bonds. Explanation. Bonds are particularly vulnerable to inflation because they offer fixed interest payments over time. When inflation rises, the purchasing power of those fixed payments decreases. Additionally, if inflation leads to higher interest rates, the market value of existing bonds declines because newer bonds will offer higher yields. However, inflation-protected bonds, such as Treasury inflation-protected securities, TIPS, in the U.S., adjust their principal value with inflation, providing some protection against rising prices. Stocks impact. Mixed to positive, in the long term. Explanation. Stocks generally offer better protection against inflation compared to bonds or cash. Companies can often pass on higher costs to consumers through price increases, which can help maintain or even increase their revenues during inflationary periods. However, the impact on stocks can vary by sector. For example, companies in industries with pricing power, like consumer staples, may perform better, while those with high input costs and little pricing power, like airlines, may struggle. Over the long term, stocks have historically outpaced inflation, making them a key component of an inflation-resistant portfolio. Real estate impact. Positive explanation. Real estate is often considered a good hedge against inflation. Property values and rental income typically rise with inflation, preserving the purchasing power of real estate investments. Additionally, the ability to increase rents over time helps real estate investors maintain their income in an inflationary environment. However, the impact of inflation on real estate can vary depending on factors like location, property type, and overall economic conditions. Commodities impact. Positive explanation. Commodities, such as gold, oil, and agricultural products, tend to perform well during inflationary periods. Since these are tangible assets, their prices usually rise with inflation, providing a hedge against the declining value of money. Gold, in particular, is often seen as a store of value and a safe haven during times of high inflation or economic uncertainty. How inflation erodes purchasing power. One of the most significant impacts of inflation on long-term investments is the erosion of purchasing power. Even if an investment grows in nominal terms, i.e., without adjusting for inflation, the real value of those returns may be much lower when inflation is taken into account. For example, consider an investment that returns 5% annually. If inflation is 2%, the real return is only 3%. Over time, Even moderate inflation can significantly reduce the real value of investment returns. This is particularly important for long-term investments like retirement savings, where the goal is to preserve and grow purchasing power over decades. The influence of inflation on interest rates. Inflation and interest rates are closely linked. Central banks often raise interest rates to combat rising inflation. Higher interest rates increase the cost of borrowing, which can slow down economic growth and reduce inflationary pressures. However, higher interest rates also impact the value of existing investments. Bonds. As mentioned earlier, higher interest rates lead to lower bond prices. Investors holding existing bonds with lower yields will see the market value of their bonds decrease as new bonds are issued with higher yields. Stocks. Higher interest rates can increase borrowing costs for companies, potentially reducing profitability and leading to lower stock prices. However, the relationship between stocks and interest rates is complex and can vary depending on the broader economic context. Real estate. Higher interest rates can lead to higher mortgage rates, making it more expensive for consumers to buy homes, potentially slowing down the real estate market. However, real estate can still offer protection against inflation through rising property values and rental income. Inflation expectations and investment strategies. Inflation expectations play a crucial role in shaping investment strategies. If investors expect inflation to rise, they may shift their portfolios toward assets that are more likely to perform well in an inflationary environment. Diversification strategy. Diversifying your investment portfolio across various asset classes can help mitigate the impact of inflation. By holding a mix of stocks, bonds, real estate, and commodities, you can balance the risks and rewards associated with inflation. Investing in real asset strategy. Real assets, such as real estate, commodities, and infrastructure, tend to perform well during inflationary periods. These assets provide tangible value and often increase in price as inflation rises. Inflation-protected securities strategy. Investing in inflation-protected securities, like TIPS in the US, can help preserve purchasing power. These bonds adjust their principal value with inflation, providing a direct hedge against rising prices. Focus on dividend-growing stock strategy. Companies that consistently grow their dividends often have strong pricing power and can maintain profitability during inflationary periods. These stocks can provide both income and growth potential, helping to offset the effects of inflation. Shorter duration bond strategy. If you hold bonds, consider focusing on shorter duration bonds, which are less sensitive to interest rate changes. These bonds are less likely to lose value if interest rates rise due to inflation. Conclusion. Inflation is an inevitable part of the economic landscape, and its impact on long-term investments can be significant. By understanding how inflation affects different asset classes and adopting strategies to mitigate its effects, investors can better protect and grow their wealth over time. Successful long-term investing requires not only selecting the right assets but also considering how those assets will perform in different economic environments, including periods of high inflation. By incorporating inflation-resistant investments into your portfolio and staying informed about inflation trends, you can build a more resilient financial future. I do not provide personal or financial investment advice, and I am not a qualified licensed investment advisor. This video's educational purpose is only to give you the basic idea. If you need a personal or financial advisor, please seek help. Embrace the journey, ignite your passions, and join us as we explore the extraordinary together. Please like the video and turn on notifications for future uploads. Thank you.